This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Graham Summers with us this morning. Graham is the Chief Market Strategist for Phoenix Capital Research. Welcome, Graham.
Hi, Gord. It's a pleasure to be here.
Well, thank you very much for joining us. I've been looking forward to it. I've been following your work, and I really respect it. And I really want our listeners to be able to share some of the great work and thinking that you've been doing specifically in the bond market. But maybe we can begin, Graham, with you giving our listeners a brief overview of your background for those that aren't familiar with your work.
Absolutely. So I'm the Chief Market Strategist for Phoenix Capital Research. And Phoenix is a business that operates based on investment strategy and research. So we don't broker deals. We don't manage assets. We simply publish our ideas of what we think people should do with their money. And if they make money, they come back to us. And if they don't, they leave. We were founded in 2009. We've done very well. And in my mind, it's sort of the best business model because it's a complete meritocracy. It's not based on inside relationships or any kind of fee structure. You simply pay for a subscription, and if it does well, you stay a client.
Well, that explains some of the writings. Most people are selling their book, or they're on the sell side or something. And then those that are on the buy side, they just no vested interest in really getting out there and talking about their strategies. So they're the right person for our listeners to be to hear from. Maybe, Graham, I need to remind our listeners here, this is part of our series on financial repression that we've been conducting. And so I'd like to frame what Graham has to say with financial repression. So, Graham, could you define it to our listeners, what it means to you and how you think of it?
When I hear the word repression, I think of the psychological concept, which is that repression typically is you're suppressing or pushing back something that's too painful for you to deal with in sort of a conscious way. And that's exactly what the central banks of the world have been doing essentially since 2008. What we had in 2008 was the beginning of a debt deleveraging cycle, or the dreaded debt deflation. The economists often like to argue that deflation's terrible, but they're being overly general there because deflation is actually a wonderful thing. We all love having items that we want to buy be cheaper. You know, no economist walks into a store and sees that steak is 50% off and is upset. He's usually quite pleased. The issue for the economists and for the Keynesians is debt deflation, which is when debt when debt loses value, or when debt begins to deflate, so to speak, you run the revolt of becoming insolvent, particularly in the bond market. And so because we've been in this debt leveraging cycle for over 30 years, a bond bubble, I guess would be the simplest way to put it, the central banks are all terrified of a bond bear market because what that means is that almost instantly most developed nations are bankrupt, because the way that they've sort of papered over the decline in living standards is by issuing more debt. And it's gotten to the point now where, because we don't actually have the money available to pay debt back, we're issuing more debt simply to roll over the old debt or to pay back the old debt. So it sounds a little bit like a Ponzi scheme, and it actually is. It works relatively well when a bond or the underlying asset is rising in value because technically, quote unquote, debt's getting cheaper, the yield is going down. But when it reverses, suddenly, if you don't have the money to come up to pay it back on the bonds, you start entering a deflationary cycle. That's what we had in 2008 in different aspects of the financial system. But that's really what the central banks are terrified of. They don't, they talk about the economy and these other things. They talk about deflation, but most of it's just nonsense. The real focus, if you look at their actions, is how do we stop the bond bubble from blowing up? And they did that three ways. The first was they cut interest rates down to zero. When they did that, they made it much more easy to finance debt. So that was the first step. The second step was they began to engage in quantitative easing. And what that was is essentially they would print money and then buy various assets from the large banks. Usually it started off as mortgage-backed securities because those were the sort of collateral items that were devaluing fastest for Wall Street. And the first round of the kind of whatever attempts to prop up the system, that was all focused on Wall Street. They didn't really care about what else was going on in the world. The second and third rounds, which we entered into after that was more an attempt to sort of keep the whole thing afloat. So by buying bonds, what you're essentially doing is you're broadcasting to the world, hey, I'm going to be buying this asset in the near future. And human nature being what it is, what's the most obvious trade in the world then? Well, it's for me to buy it before you and then turn around and sell it to you for a profit. And so globally, traders and investors have just been flocking to bonds in a, front-running central banks, so to speak. And that's made bonds rally and rally and rally, which makes the bubble bigger. It pushes yields lower. And then the third thing the central banks did was they suspended accounting standards. And that was really a bit more technical than we necessarily need to go into. But the general gist of it is that most of the large banks owned a whole bunch of illiquid assets that were essentially worthless. And because there was a selling panic, they were starting to have to sell these things. And by suspending accounting standards, the Fed and the other central banks essentially let the banks mark these assets at whatever value they wanted. So instead of saying this is worth 2 cents on the dollar, you say, oh, our internal models show that this is worth 80 cents on the dollar. This is actually very good, value, so I'm going to use it as collateral on my derivatives trades. So those are essentially what they've done. And I'm getting a bit long-winded here, but essentially repression was the central banks were trying to repress the terror of debt deflation. And what they've now manifested is a kind of financial perversion where you're seeing capital do all kinds of crazy things flowing into areas it never would go near because risk has been so mispriced by the markets.
No question. We have mispricing of risk. We have lack of price discovery. We have malinvestment. And when you start to get negative nominal rates, not just negative real rates, but you're seeing negative nominal rates in literally trillions of dollars of bonds now in Europe. It's somewhat frightening. And you mentioned, deflation versus inflation. Historically, when a society is really productive and improving productivity, you get a level of deflation. You don't get inflation until you get labor shortages, possibly, or price forces or shortages of supply. We don't have those kinds of issues right now at all. So it's really about this massive size of the debt, and I think, Graham, you can help our listeners here. A lot of people know what a bubble is in equity markets because they've witnessed it a number of times since the dot-com, but I don't think a lot of them really appreciate the magnitude of the bond bubble. Could you? I know you've got a couple charts you brought with you.
Yes, I've got one chart that shows the overall scope of the bond bubble, and if you look at that, it's over 100 trillion in size. Now, just to kind of give some perspective on things, if you want to look at the financial system as a food chain, stocks are kind of at the bottom. They're oftentimes called the dumb money. This isn't necessarily to imply that people who buy stocks are dumb. It's simply that those markets tend to be relatively small, and they're not necessarily the most sophisticated in terms of the financial modeling that goes into buying them.
Graham, I think of the equity markets as really the flea on the tail of the dog, because it's being wagged by currencies, debt, credit all the way through, and really is just a function of other markets. Is that a correct way of looking at it?
Yeah, I think so. I mean, if you want to look at it like this, why would you buy a stock? You buy a stock because it's technically a business you want to own. Because we're in a generational move into financial speculation. I mean, if you go back to the early 80s, that was really when the creation of investing's changed. Let me back up. Investing's changed over the last 40 years. In the early 80s, we started seeing stock-based retirement accounts with 401ks and so on. And then in the 90s, we had discount brokerages. So suddenly, investing in stocks and trading stocks became much more egalitarian, shall we say. And so you started getting a flood of investors coming to the markets in much higher droves, focusing on stocks than historically had been the norm. But if you invest in the business, if the business were to go broke, you go in order of precedent for who gets what. And the bondholders come first, then equities. Equities are the lowest on the rung. And in the financial system, it's a little bit like that. Stocks tend to be one of the smallest kind of peripheral markets. Bonds are much larger in scope. And then even above that is currency markets, where you're trading $4 or $5 trillion worth of capital a day. So the bond bubble is really an interesting beast because it's very different from stocks. Bonds are currently sort of the rock bed of the financial system globally because we are in a debt-based financial system. With that in mind, the benchmark for the quote-unquote risk-free rate is lending money to the U.S. government in the form of a treasury. So because of that, you have a system in which if that becomes mispriced, it ripples throughout the whole system. Put in very simple terms, if treasury bonds are being sort of pushed up so that yields are getting lower and lower, everything will react to that. Commodities, stocks, currencies, everything. And that's exactly what quantitative easing and all these other efforts that central banks have engaged in to prop up the bond bubble have created. So the bond bubble is really a strange thing because we've basically been in a bull market for bonds for 30 plus years. And that tells us two things. One, it tells us that this is a super cycle. It's not like stocks where we've had bull markets and then bear markets and bull markets and bear markets. It's something much, much bigger. Secondarily, it also tells us that there's a generational gap, meaning most professional investors and most money managers have not invested during a bear market in bonds. If they did, they'd all be older than 55. So there's an entire generation of money managing professionals who've never even witnessed anything like this, witnessed anything like a bear market in bonds. So effectively what's happened is since we switched to a debt-based monetary system, specifically one that's based on fiat currency or currency that's not backed by anything, we've entered this super cycle for bonds in which it's just gotten cheaper and cheaper to issue debt for everyone around the world. And as we've noticed, politicians have a great way of promising things, but that the money isn't actually there. And so how do you deal with entitlements or social spending that you don't have money for? Well, you borrow money, you issue a bond. Now that works just fine if the bond's rapidly in value because you never actually necessarily have to come up with the money to pay it. Let me back up. You do have to obviously pay it off, but because it's getting cheaper and cheaper to issue debt, you just issue more debt to fund whatever you have to pay. And that's essentially what we've seen for about 30 plus years in the developed world is this super cycle of a bond bubble growing because debt just got cheaper and cheaper and cheaper. And when debt gets cheaper, it becomes easier and easier to just borrow. And as a result, we're now probably in the 8th or 9th inning for a bond bubble that is sort of negating most things that people are looking at in terms of how to invest. And it's really mispriced everything. I mean, when you have over 50% of government bonds worldwide at 1% or lower, and you have, a significant percentage of bonds now in negative yields, particularly in Europe, it's something's going to go very awry. Because when you have negative yields, you're effectively paying, to invest in someone. You're giving them the money, you're lending it to them, and then you're having to come up with payments routinely to cover you having them hold the money for you.
What's troubling me the most, Graham, is the bond market is, the 800-pound gorilla here, and the currency market is even bigger and trading, maybe $4 to $5 trillion a day. The kinds of levels are phenomenal. But over on the side, you were talking about a lot of this generation has not seen a bear market in the bond market. There's something called the swaps market that measures upwards of $700 trillion. That's primarily interest and currency basis, and it's all underpinned on collateral, and that collateral is primarily the value of the bonds. And those, through a process called rehypothecation, have just pyramided themselves. So any sudden shifts destroys collateral, and everybody knows what happens when you have a margin call. And these are not traded on exchanges. These are traded by third-party banks between each other. Does that concern you?
Absolutely. I think that's actually the biggest issue we need to discuss. As I mentioned before, with the bond bubble being what it is, you have an entire generation of investors who've never experienced a bear market in bonds. That's one problem, because if a bear market begins, you have a completely different landscape. But where we shift into actual issues of systemic risk and margin calls and collapses similar to that of 2008, you then are moving into the derivatives market, as you mentioned before. Now, modern financial theory dictates that sovereign bonds, particularly sovereign bonds for those countries that have high credit ratings, are the quote-unquote risk-free money. So what that means is to you or I, when we invest in that bond, it's allegedly supposed to be a risk-free investment. It's the risk-free rate of return. If you're a bank, what that means is that is the senior most asset you want on your balance sheet that you can use as collateral for your derivatives trades. So if I own a treasury and I'm JP Morgan or Wells Fargo or some other bank like that, I'll leverage that thing up. Let's say I have $1 million worth of a treasury. I'll leverage it up 15, 20, 50, maybe even 100 times, meaning every dollar in that treasury I own will be backstopping $100 worth of derivatives trades. And that's how you get the global derivatives market, which the real issue, the scariest thing right now for investors should be the fact that globally there's $555 trillion worth of derivatives that are based on interest rates. Those are all derivatives trades made by the big banks that are effectively using bonds, because what a bond yields is ultimately an interest rate that's being traded based on. So that's $555 trillion worth of derivatives that are all trading based on bonds, which are in a massive bubble. I mean, it's just exponential leverage on top of more leverage, and the derivatives are the issue. There are a lot of problems right now with the financial system, but the problem, the one that almost took us down in 2008, was derivatives. And that problem was not fixed by any means. In fact, if anything, it's gotten exponentially worse because the bond market has become such a massive bubble now that you take whatever increase in leverage you've had in bonds and multiply it exponentially to get the increase in leverage in the derivatives market. So this is why the Fed and everybody's terrified of raising rates. It has nothing to do with the economy, and probably 90% of everything they do has nothing to do with the economy. It has to do with them being concerned that any rate hike could create a systemic event in the derivatives market. The way you know this is if you read some of the articles that have been coming out recently. They're clearly sending signals, albeit a very masked way, about this being a concern. You have the Treasury Department issuing survival kits to employees at the too-big-to-fail banks. They're doing that because if there's a systemic event, you might have a situation in which those employees have to stay around the clock in those banks, or even the banks themselves, their financial systems collapse. And then you also have the New York Fed, which is the primary operator for the Fed's market actions. The Fed is technically based in D.C., but if you have the actual branch of the Fed that engages in all the buying and selling of things, that's in New York. Well, that branch has just expanded their satellite office in Chicago, and the press release claimed that it was because they were concerned of, say, a natural disaster like a hurricane or something. That's just totally bogus. They're doing it because they want to be over in Chicago to have a sort of plan B where if the system goes down in New York, they have access to the high-frequency trading systems of Citadel and some of the other large firms out there to try and sort of engage in a plunge protection scheme to keep the system propped up. I mean, that's my view. I can't claim that's definitively fact, but it doesn't make any sense that you would argue that the issue is you're concerned about a natural disaster hitting New York. You're obviously concerned about something much larger, and if you get to the bottom of the press release, they state that they're nervous about seeing how the system reacts to an interest rate hike.
The Citadel that you mentioned, is that not the same Citadel that Ben Bernanke has now aligned himself with as a senior consultant?
That's exactly right. That to me looks like two dots that you need to connect. Citadel is the largest, most leveraged hedge fund in the United States, possibly in the world, and they're a high-frequency trading firm. And the high-frequency trading is the algorithms that have been used primarily to make money for a lot of firms, but also it's believed by many that high-frequency trading is also a very important tool that's used by the plunge protection team to sort of prop the markets up when the system begins to collapse. So, looking at Bernanke moving there and joining Citadel, looking at the New York Fed expanding its operations in Chicago, it looks to me that you connect the dots that they're bracing for some kind of systemic event.
As big a concern as the swaps and derivatives market is, and there's no question the seriousness or the exposure there, equally concerning to me is in fact what I'll call, or is referred to as the shadow banking system, and that is it's something now that measures close globally to $72 trillion. And the issue there which was actually the trigger point in the 2008 crisis, because the shadow banking system is about, in fact, borrowing short and lending long. And the borrowing short at the time in 2008 was about asset-backed commercial paper. And suddenly, when we had a shortage of liquidity, we broke the buck with the Fed, with the rate on money market funds. It just evaporated. Well, today, what we have in that massively larger shadow banking system is they're using repos and for to borrow short. They're using collateral transformations, and then again this rehypothecation to be able to fund Sally Mae, the car loans through Ally and General Motors or government motors, etc. If anything was to, and now we're seeing liquidity issues in the bond market, in the repos, could trigger a sudden somebody yelling fire in the theater. Does that concern you? Are you seeing anything there? Or am I making something that doesn't, out of something that doesn't exist?
I think you're exactly right, and I think it comes back to your initial concept of financial repression, which is simply, if you've been in a 30-plus year market in which debt has gotten cheaper and in which any kind of issue of systemic risk has been dealt with by immediately propping the market up and not letting the debts to clear, I mean, all you're doing is conditioning everybody to believe that, hey, if any time anything gets really wrong, the Fed's going to step in and save the day. That's just going to increase risk-taking. And that repression, that repressing of any debt deleveraging, all that's done is result in people take bigger and bigger risks in less and less liquid investment vehicles. And it's really manifested itself in the situation we have today. I sent you that chart of the total credit market instruments in the U.S. The 2008 debacle, which almost quote unquote took the system down, it was barely a blip in that chart. And we've almost gone vertical since. So it's really, you're talking about human psychology, because at the end of the day, it's people who are making these decisions what to do with their money. And people have been conditioned to believe that no matter what happens, the Fed's somehow going to make everything all right. And the first couple of rounds of that, maybe in the 70s, 80s, et cetera, that might have been okay. But we're now 30 years into it, and it's gotten to the point where it seems as though even if stocks drop 10%, somebody from the Fed comes out and says something, does a kind of verbal intervention to get things back off rolling. I mean, if we're in such a fragile financial system that the Fed can't even handle stocks dropping 10%, I shudder to think what things are like behind the scenes in shadow banking or in bond liquidity in some of these other places, because stocks are the ones that get all the headlines from the news. Very rarely do you hear bonds being addressed by CNBC in any really in-depth manner. So I think you're absolutely right. I think that we're seeing things just get riskier and riskier, and it's more and more fragile. Timing how and what's going to go wrong is almost impossible, because the sheer nature of it is so massive that it's impossible to even know what's out there versus what isn't. But anybody with a rational brain can look at negative yields and look at derivatives and look at these other things and know it's not going to end well.
Well, I'm looking at a chart here you sent me on the U.S. dollar and the explosion that we've had there. And we've effectively, since 2008, 2009, had a U.S. dollar carry trade going where you could borrow cheap in the United States interest rates and hoping and presuming that the currency was going to fall, and lending long in emerging markets, which has just powered supply to match this artificial demand that quantitative easing is theoretically created. But what we have now, and I quote the Telegraph, is something like $5 trillion out in the emerging markets that's on the wrong end of a loan, because the U.S. dollar suddenly is suddenly lifting. They've got a margin call. Is that what's going on there?
Sure. So you're absolutely right. There's a lot of talk of the death of the dollar. The dollar will probably at some point kick it, just like every fiat currency in history has. But before you get into that, you're going to have some sort of deleveraging cycle. And what's happened with the dollar is that if you look at a chart of the dollar going back to the early 80s, we're in this massive kind of falling wedge pattern that's been in place. And what the simplest way to put that is, generally speaking, since the 80s, the dollar's gotten cheaper. We've had, significant rallies, such as at the end of the 90s and so on. But generally speaking, the trend has been down. What that means is that it's been very profitable and lucrative and oftentimes successful for people to borrow in dollars and then plunge it into something else. Anything that was going up in value while the dollar was going down, you were making a killing. And this has fueled financial speculation with hedge funds and others, but it's also fueled expansion economically in the emerging markets. The U.S. dollar is the reserve currency of the world, and so it's very liquid. It's very easy to borrow in. So if I'm a developer in Spain and the euro is strengthening, why not borrow in dollars because they're going down? And that's essentially where you start getting a carry trade. You know, you're borrowing in one currency that's falling, well, hopefully falling, and then you're plunging it into anything else that's hopefully rising in value, and then you pocket whatever the spread is between the two. Now, this became easier and easier to do because volatility in the currency market was going down, mainly because of all the central bank interventions we were seeing. And if you actually, I think I sent you a chart of the dollar from about 2011 onward, the dollar was really trading in about a 7% range, maybe 3 or 4% up, 3 or 4% down total, which is really incredible lack of volatility for a currency. So what happened was everybody just went on a massive binge borrowing in dollars. I mean, the Fed wanted to make it easy to borrow in dollars. Well, they got what they wanted. Globally, there's now about $9 trillion in the U.S. dollar carry trade. And as you said, yes, about 5-6 trillion of that's in emerging markets. Well, that all started to blow up in the middle of 2014. You know, a carry trade only works when a currency keeps getting cheaper. Well, the dollar started to rally. And as soon as it did, it should give everyone an idea of just how leveraged the system is, because the dollar rallied almost 20% in 6 months. You don't get currency moves like that in the reserve currency of the world unless stuff is really hitting the fan. And I sent you over a chart that shows some of the currency pairs between the U.S. dollar and the Brazilian real, for instance. And you'll see that almost all of them lost between 20-30% of their value against the dollar. And I can attest this. I was in South America a few months ago, and everywhere I went, things were about 20-30% cheaper than they'd been the year before. So what's happening right now is the global carry trade in the U.S. dollar has blown up, and the most pain's been felt in the currency markets, but it's starting to ripple through the economies as well. You know, if I'm a corporate or a pension fund and the dollar, you know, rallies and it begins to blow up my position, I'm not just going to turn around and sell the farm. You can't, because you're talking about investments that are very large, like a manufacturing plant or, you know, tens of millions, hundreds of millions of investment. You don't just turn around, hit sell, and dump that all overnight. So I think this first round of the carry trade blowing up really caught a lot of attention from a lot of speculators and also a lot of just economic planners, so to speak, around the world. And I think that they kind of are brushing it off, hoping that's the end of it. And if the dollar starts to rally again, then we're going to start seeing some real panic. I think we're going to start seeing kind of the ripple effect shift from the financial markets, where you just see currencies moving dramatically. I think you're going to actually start seeing real carnage in the emerging economies.
Graham, we're not painting a very good picture here this morning, but so what and we're running up against our hard line. I need to ask you, what should investors be doing with these kinds of issues just looming in front of us?
I mean, I can't really answer that specifically because I don't know what every single person's situation is. It depends on where you are in your life and what you're looking to accomplish. In terms of our clients, we've had them been taking some very targeted positions based on all this, but just in general, for most people, the focus should be on being safe. You know, shifting to traditional safe havens. The U.S. dollar is one that comes to mind. In fact, a kind of shocking thing, I'll send you over the chart. The U.S. dollar actually returned the same amount as the S&P 500 last year. Now, you didn't hear CNBC talking much about that, but if you'd been in cash, your increase in purchasing power was equivalent to if you'd been sitting in the S&P 500. So there's really not been a huge incentive to own stocks in that regard. So the dollar's attractive. Gold, which has had a real rough time since 2011, but if you go back, gold's actually returned about an average of 10% over the last decade, in spite of the weakness in the last few years. And gold's traditionally been a safe haven for 5,000 years. So gold looks kind of attractive, although you're not necessarily going to see a kind of quick turnaround there. That's more like, where do I put my money and just sit on it for a long time? But generally speaking, I think the attitude needs to be, you really just need to look out for yourself. I wouldn't necessarily trust anybody in a position of significant power in the banking system, simply by virtue of the fact that, as Jean-Claude Juncker put it, when it gets serious, you have to lie. You're never going to see Janet Yellen or Mario Draghi or someone else come out and say, you know what, we're really screwed. Things are really bad. You know, their job is to maintain stability. So I would really just take matters into your own hands, try to get out of debt, try to be as solvent and as liquid as possible. And just really, if it doesn't make sense, don't do it. You know, it's interesting to me that you have guys like Stanley Druckenmiller who are investment legends. And Druckenmiller recently gave a speech, I believe, in January, and he said, you know, in this climate, I'm having to do things I really just don't want to do. And what he's meaning by that is just simply by virtue of the fact that to remain fully invested, you know, to sort of operate according to the standards required for various investment vehicles, he's having to put money in places that he doesn't really want to because he knows the risks are great. We don't have to do that as individual investors. There's no reason for any of us to own a stock if we don't want to. So my suggestion is don't be seduced by any kind of, you know, slick gimmicking, and just really try and be careful of yourself and just understand that what's happening right now, it's not normal. It hasn't been normal for years. And the reality is it's nothing to be necessarily hugely afraid of, because when the whole thing changes, you know, when the debt deleveraging finally completes, there's going to be once-in-a-generation opportunities to invest in some things. So, you know, the Fed may be terrified of debt deflation, but if you don't own debt, you know, it shouldn't be a huge concern for you. Just stay solvent, stay liquid, and be careful.
Sage advice, Graham, and I'm sure our listeners appreciate it. We have to wrap. Could you tell our listeners how they could follow your work and learn more about Phoenix Capital?
Sure. Our website is phoenixcapitalresearch.com. That's Phoenix, Phoenix, and then Capital, Capital, research.com. I publish a free daily e-letter where I outline a lot of these things. That's called Gains Pains Capital. You can find a link to it on our website, and it's totally free. You sign up, and we'll send you an article once a day just sort of outlining what I'm looking at, what I'm concerned about. And then we also offer some paid products, which are more designed for people who are active investors, who are looking for, you know, very specific stock ideas and bond ideas and things to make money. And you can always find information about that there too. But Phoenix Capital Research is where to find us, and everyone's welcome to come check out that free e-letter. There's no cost, there's no hidden charge. It's available to the public for free.
I really recommend to our listeners the e-letter. It's outstanding, and many times Graham is talking about things nobody else is talking about, so I compliment you on it. Graham, we have to break. I thank you very much for joining us, and we'll have to have you back again this year, because there's just always, well, there's going to be a lot more exciting things to talk about.
Yes, we live in very exciting times right now, so thank you very much. It's been a pleasure to be here.
Talk to you again. Thank you very much.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.